makers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Tom McKenzie in London. I was talking about the data coming through from the Eurozone. We have the redhead right now when it comes to September. Composite PMI rising to 51.2. Yes, 51.2. The forecast had been for 51.1. So it's a modest improvement in terms of composite PMI for the month of September across the Eurozone. When it comes to manufacturing for the Eurozone, that is in contraction, 49.5. That has fallen into contraction for September, below the 50.7 that was registered in August. But it's services that's doing the heavy lifting when you put the two together. Services coming in at 51.4, so in expansionary territory, services, and up from the previous month. So some diversion between the services picture and the manufacturing picture when it comes to the Eurozone. And, of course, you can think about trade and tariffs within that mix. Briefly checking the euro for you on the back of this. I was looking at 117 just a minute ago. 117.92 right now. The euro a little softer by 0.1%. Let's get to another major story then, from the macro picture to an individual corporate story, but of course with broader ramifications. Nvidia's decision to invest as much as $100 billion in OpenAI to support new data centers and other AI infrastructure. Let's unpack the deal and its implications for global markets with Bloomberg's Peter Elstrom. Peter, why does Nvidia feel the need to do this deal, which they'll get some equity in OpenAI? Why is it important for Nvidia?
Yeah, these AI deals, it's almost hard to keep track of the numbers now. You're talking about $10 billion, $100 billion, $500 billion deals, and we have another one that's kind of jaw-dropping in its scale. So Nvidia is talking about putting as much as $100 billion into OpenAI. That's only going to come in tranches at this point, though. The first tranche is going to be $10 billion. They're going to put that into the company. But there is some circular logic to this deal where Nvidia is turning over cash. We understand it's actually cash. And in exchange, OpenAI is going to buy chips from Nvidia to be able to build these data centers. So in that sense, they're kind of swapping money back and forth. We do think that Nvidia is going to end up buying more, generating more revenue for Nvidia than it's actually putting in. But there is some circular logic behind these deals. And the goal is Nvidia wants to stay at the heart of the whole AI conversation. They're the leader in AI chips right now. They want to stay there and make sure that they maintain their relationships with big customers like OpenAI. And OpenAI needs access to capital to be able to build these data centers, to be able to roll out most services like ChatGPT in the future.
Yeah, and as you say, it seems like at least on that metric, it's a good deal from Nvidia. They get the equity, and maybe the revenue streams from an OpenAI even match, if not surpass the amount that they're investing in OpenAI. When you think about what this says about what these companies are projecting in terms of demand for AI and services that they have in the pipeline, what does that tell us? And how are they explaining the energy piece to all of this?
Right. They've talked about these data centers that are going to be as much as 10 gigawatts of energy used in these data centers. So we're talking about a massive project now, as much as New York City consumes on its own. And they are rolling out these very big projects. We've heard before that OpenAI is partnering with Oracle and with SoftBank to be able to build data centers too. So this kind of continues that trend. Now, you alluded to the key point earlier. These are companies building the infrastructure for AI right now. What they haven't been able to do is prove that there's demand on the other side to match it. You alluded to this Bain report that came out where they talked about how the industry is going to need as much as $2 trillion in revenue to be able to justify the spending that they're doing at this point. They're not anywhere close to that track right now. So as much as Nvidia and OpenAI can cut these deals to be able to build the infrastructure, they still have to prove that on the other side, real customers are going to buy these services and they're going to pay real money for that.
Yeah, and clearly they're betting that will happen, but we watch for the evidence. Peter Elstrom, thank you very much indeed, with another big bet in terms of the AI story, OpenAI and Nvidia. Peter, thank you for the details. Now, back to the macro. The Federal Reserve's newest governor has argued that interest rates should be much lower to prevent damaging the economy. Stephen Miran was speaking in his first policy speech since being appointed by the US president.
Based on this analysis, I believe the appropriate Fed funds rate is in the mid 2% area, almost 2 percentage points lower than current policy. The Federal Reserve has been entrusted with the important goal of promoting price stability for the good of all American households and businesses, and I am committed to bringing inflation sustainably back to 2%. However, leaving policy restrictive by such a large degree brings significant risks for the Fed's employment mandate.
Let's get more from Bloomberg's Valerie Teitel. Val, To what extent is Miran proving an influence across the FOMC? What did you make of his comments, and what do you expect to hear from other Fed speakers later today?
Look, it was clear, at least in the decision last week, he had yet to convince any of the other members on the FOMC, but he is putting together an argument which might sway some members of the board when it comes to their next decisions towards the end of the year. Their next one not due until later in October. But his essentially speech laid out his reason on why he thinks that the Fed should be cutting around 200 basis points. It all comes down to the fact that Trump's policies, he thinks, are lowering the neutral rate of interest all the way down to around the 2 to 2.5% range. In that speech, there was a table. He showed that the immigration policies of Trump, the lessening of the U.S.'s population, even the tariff policies from Trump are weighing on the neutral interest rate. And that is the reason why he is backing up this view that the Fed should be cutting interest rates rapidly, using this to back up the reason why he not only voted for a 50 basis point cut last week, but wants a series of 50 basis point cuts, getting all the way to neutral in a rapid fashion. He was asked by the moderator, is he panicked that the Fed's policy rate is too restrictive? He said, no, he's not panicked yet, but he'll let us know when he is. He was also asked about whether he's a fan of the Fed's 2% target. This is something the Fed has been missing on since 2021. He said he's not a fan of precise inflation targeting. He would like to drop the precise 2% on the Fed's inflation target, but did mention, Tom, that it's not a part to move the goalposts when in the middle of the game. This is something perhaps that should be considered once the Fed gets back to 2% inflation. And this is all very important, Tom, because we don't know who the next Fed chair is, and perhaps Miran could be in that seat come May next year. So perhaps these policy views will start to gain traction in that fashion. But we do actually hear from the Fed chair himself speaking at just after 5:30 p.m. London time. Remember, we did just hear from him last Thursday, but he was speaking on behalf of the FOMC. Today, he speaks in his own personal opinion.
And we'll see to what extent there is still that divergence between the Fed chair and Stephen Miran. Valerie Teitel, thank you very much indeed. Let's bring in Luke Bars now, Chief Business and Client Officer for Fundamental Equities at Goldman Sachs Asset Management. Luke, good morning. Thank you for joining us around the set. I just want to start broadly with the equity story stateside. 28 records now year to date for the S&P 500, a $15 trillion rally for US stocks since the lows of April. How comfortable are you with the rally that we're seeing in US markets right now?
Well, Tom, I think first and foremost, we just have to accept that there has been a significant amount of positive momentum in the last few months, especially. But actually underpinning that is pretty positive progression on earnings. And so especially in that tech space, I know your last guest just mentioned the spending we're seeing in the AI space. Yes, there is an existential question over the longer term about how that crystallizes into real value and returns for those businesses. But what we've seen thus far is real money earnings. What you're seeing in the hardware side of the technology space is justifying, in many ways, the momentum we've seen. Now, what I would say is we are in the 10th percentile in terms of valuations in the US market. That means, at least empirically, you have an 80% probability of coming back at least 10% at some point in the next 12 months. So investors need to recognize there is some downside risk in the near term, but we remain pretty constructive over the medium and long term. And I think crucially, let's not forget, we've been in that 10th percentile for the last decade. And so as long as earnings continue to come through, as long as we see progression on the fundamental front, that gives us confidence that the market stays in a healthy space.
OK, so we have to see those earnings continue to justify that 10th percentile. What is the biggest risk then for a move lower? Is it the earnings story degrading, or is it something else?
Well, I think there's going to be existential threats that are always going to be hard to judge.
Yeah.
Obviously, we have a fiscal policy in the US and fiscal deficit is widening. We have just discussed what Fed policy is going to look like. And, you know, the scatter plot from last week was a little bit all over the shop. So looking at what the forward path is part of that assessment. But underlying what we've seen in the last year, at least in the last 6 months, is this positive progression in earnings. And that's what's underpinning what are still elevated valuations. So for us, business fundamentals remain crucial. Yep. Returns on equity remain crucial. As long as we're seeing those, we remain comfortable with where the market is trending. If we see some wobble on that front, and there are parts of the market that are starting to look a little bit more challenged, and we are seeing bifurcation in winners and losers to some degree, that gives us a good, healthy environment for active management. But big picture, on aggregate, things are still doing relatively well.
I just want to go back briefly to your comments on tech. Do I read from that you're not concerned about a bubble in AI, or is it more nuanced?
I don't think we're concerned about a bubble. This isn't dot-com crisis of the early 2000s. We're talking about businesses, especially take those top 5 in the index, that are generating 65% ROE. You're talking about businesses that, yes, are on a healthy multiple. When you think about it on a cash flow basis, given how cash generative these companies are, actually we remain fairly constructive. Yes, you have to be selective, and yes, you have to think about, especially in some of the hardware side of things, the progression of competition or the demand and supply cycle in something like semiconductors as you see a normalization in AI CapEx. But again, we've talked about AI CapEx normalization. We've talked about the focus on returns on capital for those big hyperscalers. And we're still seeing 50+% increase in CapEx this cycle. We're going to see $1 trillion of AI CapEx over the next 3 years. We're going to see $350+ billion of AI CapEx this year. And so that story is still very much entrenched and driving the market.
And we're not near, it sounds like you don't think we're near the end of that story. This is maybe 1, 2, maybe 3 years still further to go in terms of that as a catalytic effect for the markets.
I think it's going to evolve. I still think it's underpinning a lot of the positive momentum we see in the US market. I think we have to be very cautious over just saying universally everything will do well in that space. And I think what we are finding is the derivative beneficiaries of that AI trend are starting to look more attractive on a relative value basis. So I know Peter mentioned a second ago the power demand side of things. As you're building data centers, you're training your AI models, you need that increase in power supply. And so where you can find that through grid infrastructure, where you can find that utility space, you're not paying your 30+ times multiple, you're paying a much more muted multiple, but for relatively compelling growth for what has largely been a low growth industry historically.
You talked about areas of the equity market that are looking vulnerable right now. Where specifically are you concerned?
Well, I think in the US, what we have seen in the last couple of quarters is a bifurcation on the consumer side. We are still seeing positive momentum largely in the luxury space. But in the lower end or middle end consumer, you are seeing a little bit of attrition, and that trade down effect is starting to play through. And so that's a good indicator of where economic health is. Again, we're not overly concerned at this stage. We still think economic health is fairly positive and the progression of US economic growth is robust. But you are seeing that bifurcation. That is starting to weigh on some of those middle consumer, lower income consumer type categories.
When it comes to Europe, are markets overestimating or underestimating the impacts of fiscal stimulus, defence, infrastructure spending coming through from Europe?
So I think short term, we've seen a very strong rally in Europe. And so I think to a degree that is betting on the fiscal improvements you're seeing, the spending packages you're seeing, and this belief that Europe can harmonise and drive competitive advantage in a way that it hasn't done for many decades. Now, I would say valuations have re-rated and earnings haven't necessarily kept up at that same pace. And so the short-term picture is a little bit more balanced. You have to be a little bit more selective. But I would still argue that medium to long term, the backdrop for Europe remains incredibly healthy. And on that fiscal side of things, I mean, let's just use Germany as the simple case in point. We're talking about 12 months ago, fiscal consolidation in Germany, fiscal deficits reducing to 1.5%. We're now talking about over the next couple of years, German fiscal deficit could increase all the way to 3.5% to 4%. And that is being effectively driven by this need to improve spending on defence and to upgrade infrastructure. Again, not that the AI story is as prevalent in Europe, but that power story is still very relevant. We're talking about 40% of grid in Europe, 40% of power transmission in Europe is on 40-year or 50-year-old grid infrastructure. So you have to upgrade that infrastructure. That's what's driving the fiscal spend. And so if you can find pockets of growth that are going to have that existential or transformational change, that's very positive.
Does that also unlock a CapEx revival?
I think it does, for sure. And I think that animal spirits in Europe that's been a little bit tempered for much of the last decade as US has continued along this very, very positive track of momentum is starting to play through a little bit more evidently. Again, it's not universally across all sectors, and there's still areas where, you know, we are cautious on the nearer term fundamentals and the operating efficiency of some of these businesses. But if we look into areas like industrials, if you look at some of those utility infrastructure businesses, and actually even the story you've seen in financials in the last 12 to 18 months has been progressively positive.
What do you say to those clients who may come to you say, we're concerned about our dollar exposure at this point? Is that concern still justified? How are you thinking about the dollar as a trend and how much exposure you want your clients to have?
It's actually been one of the biggest topics of discussion this year because probably for the first time in a decade, people have had to really think about it. For a long time, if you were long US assets, you were getting the benefit of translation effect of strong dollar. And so that started to move a little bit. I would say at this stage, we're fairly balanced. We can see some small downside risk to dollar, but it's not significant. What I do think is largely overblown, and one of the conversations we've had a lot internally, is this idea that the US dollar is no longer the global reserve currency. Yes, there has been a change in reserve mix for some of the, let's say, emerging market central banks. You have seen this buying of gold as a hedge against that, but you're still talking about 60% of foreign reserves sitting in central banks being US dollar. You are seeing this emergence of stablecoin and buyers of US dollars that's helping to hold that market up in a pretty meaningful fashion. So for us, at the margin, a little bit cautious, but nothing that's overly concerning our overall equity positioning or portfolio positioning.
Luke, thank you very much indeed. Really smart takes, of course, when it comes to US equity story in Europe as well. Some of the opportunities, maybe thinking about the fiscal spend that's coming through. Some of that priced in, but still some way to go on that journey. Luke Byers, Chief Business and Client Officer for Fundamental Equities at Goldman Sachs Asset Management. Coming up, France formally recognising Palestine as an independent state while calling for an immediate end to the war in Gaza. Details ahead. This is Bloomberg. Lithuania's president says Russia is testing NATO's readiness by repeatedly sending armed fighter jets into the airspace of its member countries. His comments come after 3 Russian fighter jets entered Estonian airspace last week. Estonia's foreign minister says Russian President Vladimir Putin is testing NATO's unity.
Putin is playing is a fire, and next time if we see the immediate threat to our territory or to us, it can be different. So Putin is trying to escalate and also trying to test our unity and capabilities, but he's failing normally.
Let's bring in our Europe correspondent Oliver Crook, who's been following this for us. Ollie, give us the context, the framing around how we should think about these incursions into Estonia in light of what we've been seeing more broadly in terms of what seems to be an emboldened Russia.
It certainly seems to be that way, Tom. And before speaking to Bloomberg Television, the Estonian foreign minister was before the UN Security Council, a meeting that Estonia had called ahead of the UNGA in New York City in order to basically detail what happened on Friday. And we got a little bit more detail from him about what this incursion actually looked like. So it was 2 MiG-31 fighter jets that were fully combat ready. He says that were carrying sort of payloads that entered 10 kilometers into Estonian airspace and stayed within it for 100 kilometers. And he pulled up some maps and some radar pictures in order to show as evidence of this in front of the UN. And when you look at these, you're really struck that basically the direct line along the coast where they went in is right where the capital of Estonia is Tallinn. Again, the Russians have denied that they did this on purpose or that they did this at all. But if you wanted to send a strong political signal and a strong military signal, that is probably exactly where you would fly those kinds of planes. What you're now awaiting is a kind of full sort of appraisal from the United States and what their response is going to be from this. We've heard from Trump say a few fragments on this over the last couple of days. He was asked on Sunday whether or not the United States would come to the defense of Baltic nations and Poland, and he said that he would. However, Tom, it's very different to say if your nation is invaded, the United States will come and be there. Will the United States really want to stick around and really support fully Baltic nations or any other nation in NATO shooting down Russian aircraft that are in their airspace? That is some of the really dangerous ambiguity that exists within the situation. And probably as far as Putin is concerned, a couple pilots and some aircraft are a very sort of low price to pay to find out what Trump and the White House's appetite is to defend NATO.
And that talks to the fine line, doesn't it, that is being thread by NATO in terms of escalation versus deterrence, and to what extent those two become blurred.
Absolutely. And this is going to be the conversation that is happening today in Brussels by the NATO foreign secretaries that sort of attend and represent NATO that are having a meeting today that was called by Estonia. Remember, this event triggered the Article 4 being called by Estonia. This is the article where you have consultations when territory is threatened by any of the NATO states. We should say that has, again, only been called into force 9 times since 1949, and 2 of those times were in the sort of last 2 weeks. We've also heard from the Polish. The Polish has been very clear. Donald Tusk came out last night and said that we will most certainly take decisions to shoot down flying objects when they violate our territory and fly over Poland. And the Polish foreign minister, even more bold, saying that if another missile or aircraft enters into our space without permission, deliberately or by mistake, and gets shot down and the wreckage falls on NATO territory, don't come here and whine about it. You have been warned. So again, some really sort of aggressive words and speaking exactly to that line, Tom, of this question, this fine line between deterrence deterrence and escalation. We got a little lesson in that, about 10 years ago from Turkey that shot down a Russian bomber plane that went through its airspace near Syria. That plane went down. One of the pilots ultimately died because he was captured by Syrian rebels. That caused a massive diplomatic stir. It did not cause a military escalation, though it did result in President Erdogan writing a sort of letter of apology and regret to Vladimir Putin. So these are the sort of dangerous conversations that we're forced to have as we get closer to these sort of incursions into airspace. We'll be asking, the Estonian Prime Minister a little bit later today when I speak to him about what the response is. Are they willing and ready to engage with Russian aircraft if they incur into the airspace once again?
Ollie, thank you. Bloomberg's Oliver Croak with the latest on that front. And Ollie, as he mentioned, will be speaking to the Estonian Prime Minister later, so do stay tuned for that conversation, of course, on Bloomberg. Now, France has formally recognised Palestine as an independent state while calling for an immediate end to the war in Gaza. It follows similar action by other countries, including the UK, Canada, Australia and Portugal.
Le temps de la paix est venu.
The time for peace has come because we are moments away from being unable to grasp it. That is why we are here today. Some will say too late, others will say too soon. One thing is certain, we cannot wait any longer.
Nous ne pouvons plus attendre.
Let's bring in Bloomberg's Jemana Pasechi in Dubai. Jemana, what stood out to you from this speech from the French president?
Well, it was certainly a historic moment. Remember that this was an event that was spearheaded by both France and Saudi Arabia going back a couple of months. And there has been a coordinated effort from many Western nations, G7 nations, to move to recognize Palestinian statehood. President Macron speaking yesterday, going for that step and recognizing Palestinian statehood, and also suggesting that at some point they could actually open a Palestinian embassy in France once the war is over and once the hostages are released. We also heard from the Saudi foreign minister. He was representing the Crown Prince Mohammed bin Salman, echoing also what President Macron said, calling for global recognition of a Palestinian state and also calling for the end of military aggression in Gaza and also increasingly in the West Bank as well. Now, this takes the total number of UN members to around 80% that do recognize a Palestinian state, the exceptions being about 39 countries, United States, one of them. The Secretary of State, Marco Rubio, saying the decision is reckless. And of course, Israel themselves, with the Israeli Prime Minister saying on Sunday that there will be not a Palestinian state. It will not get established. And many within his own party are saying that actually they should be expanding settlements further in the West Bank and go one step further than that and perhaps talk about the annexation of West Bank for many countries around the world. That may be perceived to be a red line, not least the United Arab Emirates, which is a signatory of the Abraham Accords. But Prime Minister Netanyahu will be delivering a speech to the General Assembly on Friday, followed up by meeting with President Trump on Monday. Thereafter, he says he will deliver his response to the countries that have recognized Palestine as a state.
Horizons Middle East and Africa anchor Jemana Pasechi, thank you for that update. We're going to get back to the data on Europe next. Stay with us. This is Bloomberg. Good morning. Welcome to The Pulse. I'm Tom Mackenzie in London. These are your top stories. The euro area's private sector expands at the quickest pace in 16 months as outperformance in German services compensates for a slump in France. UK data is breaking now. I'll bring that to you shortly. Nvidia to invest as much as $100 billion in OpenAI to help build more data centers. This as a report from Bain warns of an $800 billion revenue shortfall in AI. Plus, Baltic leaders say Russia is testing NATO's readiness to retaliate after a series of air incursions. Let's bring you the breaking lines on UK September services data and the composite number as well. It's a pretty ugly picture here in the UK. September services PMI falling to 51.9. So, OK, still in expansionary territory, but well below the forecast of 53.5. So services PMI 51.9, below the forecasts. Still in expansionary territory. The composite PMI number also slipping, well below the forecast, coming in at 51. The forecast had been for 53. So again, still in expansionary territory for composite PMI, but well below the forecast. Checking the pound for you right now on the back of these lines. 134.97, so just shy of 135 on the pound, a little softer, down 0.1%. Meanwhile, French private sector activity fell to the weakest level in 5 months as the country grappled with a fresh bout, of course, of political turmoil. However, German private sector activity rose at the fastest pace in 16 months. The trouble seems to be brewing for manufacturing as new orders took a nosedive. There is a divergence between services and manufacturing. Let's get the context, the analysis, and bring in Josie Anderson, European economist at Nomura. Josie, we'll get to the UK data, but let's start on Europe. What have you learned from the data that's crossed when it comes to PMI, manufacturing, services, composite across the Eurozone this morning?
Yeah, thanks. So it's definitely a mixed bag that we've seen this morning. Obviously, weakness in France below our forecast, consensus forecast, likely related to that political turmoil causing some uncertainty. And then strength in services over manufacturing. For that, you have to question, has there been an impact of those tariffs, that 15% we saw for the EU that started in August? Obviously, higher tariffs on exports to the US will likely lead to weakness. The bigger picture, though, we think there's some positivity down the line, particularly in Germany, from that fiscal boost that they're likely to see coming through, more spending on defence and infrastructure. So that's longer term, but today's numbers were quite a mixed bag. In the UK as well, we expected some weakness, but yeah, that was disappointing.
Well, it's interesting you talk about, and you flag when it comes to France. We'll move on to the UK. When you talk about France and the politics, arguably there's a sense, or there's evidence now that instability is already feeding into the data, the September data for France. Where do you think we are in the France story? I mean, what are you looking for that would make you think, hang on, we're moving from a fiscal crisis to an economic crisis in France?
Yeah, I mean, there's a lot of uncertainty there, as I mentioned. Obviously, we do have a new Prime Minister now, and his task is, of course, to grapple with all the differences across parliaments and get through a budget that people will agree to. But obviously, that's where Bayrou failed, and lots of people want different things. His suggestion of 2 fewer bank holidays was very unpopular. But France does have to, consolidate its fiscal situation. Its debt to GDP ratio is very high, and at some point, that threatens bond markets and financial stability in the country.
Well, the bond markets here in the UK are moving. Gilts are bid. You're seeing yields down between 2 and 4 basis points. So down to almost 3 basis points on the 2-year, which is yielding 3.95 right now. And at the long end, 5.5% on the 30-year. So yields down 5 basis points. So money is moving into gilts on the back of weaker than expected data. How bad is this data? Does it change your view in terms of the BOE?
I think month-on-month moves in PMIs don't necessarily read through into overall GDP data. But actually, in terms of the Bank of England, we know that the Bank of England, of course, does watch this data, and it also feeds into its estimates of what survey-based underlying GDP growth. So, of course, headline still an expansion. We're not looking at recession here. But the Bank of England does keep a close eye on economic activity. And, of course, the big question is when, if the next cut will come. We're still expecting a November 25 basis point cut. And, of course, that would be related to potential labour market and economic weakness, but, of course, also slower inflation.
So you think the BOE does cut in November, but you don't necessarily think today's data supports the case that it does? I mean, does it reinforce that view? Does it make November more likely, in your view?
Yeah, it certainly supports it. I think the main data sets you've got to look out for are, of course, labour market and inflation. So that will be coming through. That's what we're really keeping an eye on. But it's still a live meeting, we think. And
we got German data. That was also a bit mixed as well. But you were suggesting earlier that you think actually the fiscal impulse is going to be significant in Germany. What are the multiplier effects of spending on defence, spending on infrastructure, and when does that become a material story for Germany?
Yeah, so as I said, we're quite positive. Obviously, it will take time to feed through. It takes time to make decisions about where you're going to spend. And so this year, we're less, the story is more tariffs than infrastructure and defence spending in Germany. But we do expect, into 2026, that to start to dominate. And we're excited about German economic prospects.
OK. I know you're interested as well what's happening in Sweden with the Riksbank. And that decision, I think we can characterise it as a surprise. Most thought they would hold rates at 2%. I think you were included there as well. They cut 1.75 now. That's the rate from the Riksbank, 1.75%. Are they done? And is there an inflationary risk here?
I would say yes, they're done. That's certainly what they signalled today. Their projection for the policy rate continues to be now at this new rate of 1.75% into next year, but then rise slightly. You know, we're talking by the end of its forecast projection, though, in 2028. So this is a new normal, is what they're saying. It was a close call, though. Yes, we expected the rate to stay unchanged, and Anna Seen, Deputy Governor, also preferred that option, it was stated today. So it was an interesting decision, certainly.
I wonder, so you got the ECB at 2%, the Riksbank at 1.75%, the BOE at 4%. I wonder to what extent the ECB is looking at the Riksbank and whether or not that is something that percolates through the minds, particularly when you have a bit of a mixed picture on the data front out of the Eurozone. Is the ECB firmly on the sidelines, do you think, into 2026?
I think, you know, when separate countries have different economic cycles, they can see different adjustments in their policy rates. Obviously, both in the EU, the euro area, and the Riksbank, their policy rates can be closely linked, and FX movements can affect that too. But we do think the ECB is at 2% for the foreseeable future, and that's because, you know, inflation is comfortably at the 2% level, and we think they'd need to see some kind of change in their 2027 forecast to actually shift the dial on whether or not they move their policy rate.
Josie Anderson, thank you very much indeed. Doing a bit of tour of the central banks and the data, of course, that's come through this morning. Josie Anderson, European economist at Nomura, thank you. Now, the Resolution Foundation, going back to the UK, an influential think tank, of course, says UK Chancellor Rachel Reeves could raise £6 billion of income tax without hurting employees by aiming increases at pensioners, landlords and the self-employed. Ahead of the November 26th budget, it is proposing to cut employee national insurance by 2 percentage points and raising the basic rate of income tax by the same amount. This recommendation is significant because former Resolution Foundation staff now hold senior positions at the Treasury. And Hong Kong is facing potentially the most damaging cyclone since 2018 as Super Typhoon Rugasa tracks toward the financial hub after lashing the Philippines and Taiwan. Hong Kong's international airport is expecting major disruptions, and schools have been closed on Tuesday and Wednesday, with similar measures being put in place across parts of southern China. The United States and China are in the final stages of negotiations for what US officials are calling a, quote, huge order for Boeing aircraft. It comes after a delegation of American lawmakers ended 2 days of meetings with Chinese leaders. Details of the potential order revealed by the US ambassador to China, David Perdue.
This is a huge order, and it's very important to the president. It's very important to Boeing. I think it's very important to China. And I think that we're in the last days of that, or weeks of that negotiation, and we're hopeful that that will turn out to be the case.
Let's bring in Bloomberg's Brendan Murray, who leads our global trade coverage. So the ambassador, Brendan, saying the order is huge. How significant is it really in terms of the totality of trade between the US and China?
Yeah, well, it sounds like it's going to be another step in a direction of bringing the U.S. and China closer economically and diplomatically. Those relationships have been on the diverging in recent months. It was just a couple months ago that President Trump said so much for being Mr. Nice Guy with China. But now it sounds like Beijing and Washington are trying to put some of the pieces of this back together. One of those, of course, being this Boeing deal, which would be huge. It would be hundreds of planes. It would end Boeing's sales drought in China dating back to 2017. So President Trump, this is the pattern that we've seen. He likes to see countries offer things like purchases of Boeing aircraft. In the U.S.'s trade relationships with these other countries. We've seen it time and time again. There are also deals in the works that Turkey is going to buy some Boeing planes. Qatar also announced some of these purchases recently. So this is going to be a big deal. It's not anything that's going to be announced other than by the two leaders, depending on when they're going to finally get those arrangements together. It could be at APEC in late October, early November in Korea, when Xi and Trump plan to talk. But definitely this would be a big economic boost, just not only to Boeing, but also to the constituencies in those states across the U.S. where Boeing employs a lot of people, and, of course, members of Congress as well.
And Brendan, you and the team have been reporting around China in a time, of course, of increased tariffs from the US, has actually managed to increase its exports. How has China managed to do that?
Yeah, exactly. Through July this year, Chinese exports to the U.S. of goods are down about 20%. But what we're seeing are those goods the Chinese manufacturers are selling to other markets like India, countries like Brazil, South Africa, and elsewhere. We're seeing a flood of Chinese goods, in low-priced Chinese goods, going to markets like this because of the tariff wall that President Trump has put up. So these exporters in China are really showing their durability. The question is, how long are these? Will these other countries take it? This flood of, some would say, dumping of Chinese goods in those markets that will hurt domestic producers. How long can those domestic producers withstand that influx? And will governments try to respond with things like import barriers themselves? So it's China looks to be on a fairly solid course right now for its exports for the full year.
OK, Bloomberg's Brendan Murray, thank you very much indeed on the agility of Chinese exporters there and that potential Boeing deal as well as we look ahead to that potential meeting between the two presidents in person, possibly in October. Now, to the domestic story in the US. Disney saying that the US chat show host Jimmy Kimmel will go back on air today, nearly a week after he was suspended, of course, over remarks related to the murder of conservative activist Charlie Kirk. The company says it reached the decision after having what it called thoughtful conversations with the host. For more, let's bring in the editor of Bloomberg's Daybreak, Mark Perrier. Mark, what do we know then that led to the decision to get Jimmy Kimmel back on air? It's only been a week.
Well, obviously, quite the week for Jimmy Kimmel. What we know is that Disney says they had thoughtful discussions with Kimmel to bring him back. Reportedly, Disney CEO Bob Iger was involved as well to persuade him to come back. Kimmel hasn't spoken yet about what his reaction to this whole debacle from the last week. We're going to find out tonight when he addresses the nation in his return.
And this has much broader significance beyond just one late-night host, beyond Jimmy Kimmel. This has raised all sorts of questions about the freedom of speech and about what critics would say is edging towards some form of censorship in the US.
Indeed. The wider discussion obviously involves freedom of speech. Conservative groups were obviously upset by Kimmel's reaction and words regarding the killing of Charlie Kirk. So I think, I think this will has the potential to continue and develop into an even wider story. But again, we have to see what he says tonight. Will he be controversial? Will he take a step back? We're all waiting to see.
Yeah, there'll be a lot of people tuning in. Mark, thank you very much indeed for the context around that story, the developments, of course, and the broader implications amidst that debate around free speech in the US. Coming up, a win for Orsted. We're going to switch focus and look at the court rules around Orsted, a court ruling it can resume work on its nearly completed wind farm in the US. We will bring you the details. The stock is on the move, up 7%. This is Bloomberg.
Anglo holds 85% stake in De Beers. And Botswana, the government of the Republic of Botswana holds 15. We are resolute now, and we've communicated a firm intention to increase our stake in De Beers to a controlling stake that is upwards of 50%.
Would you go higher than that? Would you consider taking it over?
Yes, we'll go higher.
Why?
But because we want to have effective control of the industry. We want our voice to be heard. It's a matter of economic sovereignty for Botswana. It is absolutely imperative for Botswana at this point, particularly, to take a more active role and increase its stake.
That was Botswana's President Duma Boko. Now, to the renewable energy space and another twist and turn in this saga. Orsted shares surging after a US judge ruled that construction can continue on its nearly completed wind farm off the coast of Rhode Island. The project had been halted due to a Trump administration stop work order. We're joined by Bloomberg Energy reporter Will Mattis. Will, I've kind of lost count of the number of times that this story and the outcomes for Orsted have changed as a result of some adjustments from the Trump administration and then the court rulings on this. Where did things stand? What exactly did the court rule in this particular point in this story?
Yeah, well, almost always when there's news coming out of the U.S., it's bad news for Orsted. And this is the rare exception where something has happened in their favor. And basically, they sued to stop the Trump administration from halting work on their wind farm, which was costing them, they said, about $25 million every week. And the judge last night ruled that they could continue work while this case is ongoing because, A, he thinks they're going to win, and B, he thinks that it is really severe harm for them if they are forced to stop work in the meantime.
Remind us how we got to this point and what the cost of these delays are in their totality.
So, I mean, Trump has been an antagonist to wind for a long time. He hated an offshore wind farm that was built off his golf course up in Aberdeen. And as far as I know, that's sort of the origin story of his wind farm ire. He says all kinds of things.
He says he's worried about the birds as well.
He says he's worried about the birds. He says they cause cancer. He says he's worried about whales.
He says they cause cancer?
He says
Goodness.
that.
Okay.
We have a lot of wind in the UK here. I'm not aware of any wind farm-related cancer patients. But that's what he says, and he hates it. And his administration has done everything they can to stop the growth of offshore wind in particular.
It sounds like you've already answered this part of the question, but could this mark a turnaround for the prospects of wind companies operating in the US?
This would mark potentially a floor. So I think that when Trump came in, a lot of people in the industry thought that, maybe new things will not be allowed to go ahead, but things that have already been fully permitted that have those sort of contracts will be allowed to continue because, a contract is going to be honored. But Trump came in and said, issued a halt work order on another offshore wind farm, issued this halt work order on Orsted, and basically sort of all bets were off in terms of how far he would go to stop wind farms. And even if his actions end up being illegal, what we see in the case of Orsted, I mean, they have suppliers, they have contracts, and when there is a stop work order, those contracts are at risk of sort of running out of time, and that they would then have to sign new contracts at higher prices, and maybe in a worst case scenario, the project would become just too costly and they'd have to cancel it. So
what do you say, what is the impact on investment into the US? Because the Inflation Reduction Act was seen as a huge catalyst for European investment into renewable energy in the US, and was seen as a long-term story, given that it actually was a bill that was signed by the former president. To what extent has that unwound?
Well, it's a mix because at one point, on one side, the U.S. is definitely riskier now. Especially, offshore wind is the riskiest because there's the biggest exposure to the federal government. They have this power over the seabed that doesn't really matter what the states do. The U.S. government has signed off on that. On land, onshore wind, solar, the subsidies that were available from the Biden administration are going away much faster than people thought. But at the same time, you have explosive demand from data centers, with hotter summers, air conditioning demand going up as well. So you have huge demand, and supply needs to meet that. So that's actually quite good for the renewable energy sector. And, what it could mean is that prices for consumers are going to be higher than they otherwise would have been.
Bloomberg Energy reporter Will Mattis, thank you very much indeed for that update. Now, the Trump administration, meanwhile, has told pregnant women not to take Tylenol or paracetamol, saying it is linked to autism. That is despite a lack of widely accepted scientific evidence to support the risk. Shares of Tylenol's maker, Kenvue, slumped to a record low, but reversed some of those losses after the bell.
So taking Tylenol is not good. All right, I'll say it. It's not good. For this reason, they are strongly recommending that women limit Tylenol use during pregnancy unless medically necessary.
And the White House says doctors may be exempt from a sharp hike in visa fees for skilled workers if it's deemed to be in the national interest. Hospitals have warned that the $100,000 fee for H-1B visas could worsen the shortage of doctors in rural America. Switching to defence now, European defence ETFs have gathered almost €4 billion in assets in just 6 months, making it one of the fastest ETF growth stories ever. It comes after the EU looks to mobilise over €800 billion as part of its commitment to develop its defence industries and recognises private funding needs to be an essential part of that plan. The first European defence ETF was launched in March, with numbers increasing to 8 in just 6 months. Bloomberg Intelligence ETF analyst Henry Jim is in Geneva with some of the details. Henry, why are these ETFs so important then?
Hi, good morning. Yes, European defense ETFs are really important because for the EU, this is a way for them to match investments to the capital expenditure needs of defense companies. For investors, this provides an alternative or a way for them to look for returns outside of the regular broad equity indices, which have, in euro terms, really been flat year to date. Whereas, for example, the Bloomberg Europe Defense Select Index has returned 86% year to date. And lastly, for the ETF industry, this is a really important development because we're seeing a lot more new users coming in the industry, and it really showcases how ETFs can not only match investors with investment needs, but also as a way to provide investors a way to express their investment beliefs.
Henry, is it your assessment, you and the team at Bloomberg Intelligence, that this kind of growth is set to continue?
In terms of assets, definitely. We've seen already $4 billion enter into just the European defense ETFs. That's remarkable, but just to put in context, we started the year in all defense ETFs in Europe with just above $2 billion. We're now at $14 billion. And $4 billion of that is in European defense ETFs themselves. Now, in terms of the number of ETFs, not so sure. We already have 8 European defense ETFs, so I think we're pretty much saturated. I could see the case that all the major issuers I've already pointed out, but I can see a case for, say, another issuer who wants to complete their product lineup, or who have a keen institutional investor who wants to invest in Europe defense, who may come in with a product too. But right now, the first and biggest European ETF, it's already cornered the market. It's got by Wisdom Tree. It's got about almost close to $4 billion in assets now. The next 3 among them, they split 4% each, so 12% of the market. So that's Amundi, Han ETF, and BP Paribas. So it's already a pretty saturated market. But definitely more growth in assets, but not so much in number of ETFs.
Really interesting insights, and there's more detail, of course, if you are a Bloomberg subscriber. You can get more details, more analysis, of course, from Henry and the team at Bloomberg Intelligence. ETF analyst Henry Jim with those insights into the flows into defence ETFs here in Europe. Now, Fed Chair Jerome Powell speaks at just after 5:30 p.m. this time, UK time, of course, 5:30 p.m. UK time. J-Powell, we will have live coverage on Bloomberg Television, and we're going to be speaking to the Latvian president and the Spanish Prime Minister at the United Nations General Assembly. Up next, Bloomberg Brief. This is Bloomberg.